Hey guys, Ben here, helping you earn more, spend less, and invest the difference. Now in today's video, we're going to be talking about an LLC and how you're going to set it up so that you can actually pay yourself out of this LLC and what are some of the tax consequences of all of this stuff. Now typically when you start your own small business, you're going to set it up as one of two business entities, either a sole proprietorship or a LLC. That's usually where people start out. Now with a sole proprietorship, your business and you as a person are essentially the same thing. The business's money is your money, and your money is the business's money. You don't have to file any paperwork with the state. You don't have to register your company. You don't have to file any additional paperwork with the IRS. You just pick up and go to work. It really is that simple with a sole proprietorship. Now with an LLC, a limited liability company, you first have to register your company, usually with the state. So there is going to be some paperwork that you have to file to actually register your company as an LLC. Now with some states, you just have to do this once, and usually there's a little bit of a fee involved with the paperwork. And other states, you have to do this every year. You have to renew your LLC paperwork. So it just kind of depends on what state you're in. All the rules are different. However, once you've set up your LLC, now you've got two distinct entities. It's not one and the same like it is with the sole proprietorship. Now your business LLC is completely separate than you as a person. So your business's money is not your money. You can't spend that money on rent and groceries and that kind of stuff. Likewise, your personal money is not your business's money, so you can't be using your personal credit card to buy inventory and do marketing for your business. So since these are now two distinct entities, how do you actually pay yourself? That way the company's profits, you can use it to pay rent and groceries. How does that process work? Well, thankfully, it's actually super easy. Now you are going to want to set up a separate bank account. That way you can keep the money separate between your personal and your business bank accounts. And then all you're going to do in order to pay yourself is you're going to write a check from your business bank account and make that check out to your name. And then you're just going to cash that check into your personal checking account. That's it. All you're really doing is writing yourself a check from the business to you as a person. Now obviously when you write yourself a check, you're probably going to want to leave at least a little bit of money in your company because you want your company to be well capitalized. That way your company can pay all of its expenses, inventory, marketing, advertising, all that kind of stuff. So you want to leave probably at least some money in your business account. You don't want to transfer everything to your personal account because then your business can't really do much of anything. It doesn't have any money. Now when it comes to tax time, LLCs can be taxed in a variety of different ways, but by default, they are a pass-through entity, which means that you don't have to file any additional paperwork. So your personal taxes, you're just going to include your LLC income and expenses and all that kind of stuff in your taxes. You don't have to file two completely separate tax returns. So by default, let's say that you have a normal W-2 job and you've also got a side hustle of some sort. So let's say that your W-2 job, you earn $40,000, and with your side hustle, your startup LLC, you earn $20,000. So realistically, you would just file one tax return and it would include both pots of money. So you would be taxed as if you had made $60,000 for the year. But there is one caveat to all of this, is because at some point you're probably going to want to pay yourself. So you're going to want to take money out of your company and pay yourself. So let's say that hypothetically of that $20,000, you want to leave $5,000 in your company to pay expenses, and you want to withdraw $15,000. You want to write yourself a check and get that $15,000 so that you can spend it on car payments and groceries and all that kind of stuff. So there is a separate tax event that happens with that, because when your company is paying you a salary, you are effectively self-employed. So you're going to pay self-employment taxes on that $15,000 that you transfer from your business to you as a person. Now, self-employment tax is in addition to federal and state income tax. Self-employment tax currently is about 15.3%. of which roughly 12.4% is going to be for Social Security and the other 2.9% is going to be for Medicare. So you would get taxed this extra 15.3% on the $15,000 that you take out of your business account and put into your personal account by writing yourself a check. Now, when you write yourself this check, the way that you're going to do the bookkeeping with your business LLC for accounting purposes, all of my accounting nerds out there, you are effectively going to debit your owner's equity and credit your owner's draw accounts. That's going to be the way that you're going to set this up using double entry bookkeeping. So that's really it, guys. Don't try to overcomplicate things with your taxes and pay in a single member LLC. Now, unfortunately, that self-employment tax, it really sucks. It can start to bite into your profits. So at some point, if your company makes enough money, I usually recommend somewhere between like $30,000 and $50,000. It might be beneficial to actually elect to be taxed as an S Corp instead of an LLC. Because once you elect to be taxed as an S Corp, you can divvy out those profits into two distinct categories. So as an LLC, we were just taking the $15,000 out and we were paying self-employment on all $15,000 of it. But if you decide to tax yourself as an S Corp, then maybe you pay yourself a salary of $10,000 and the other $5,000 is just simply going to be business profit. And so you're only going to be taxed that 15% on the actual salary that you pay yourself. The other $5,000, that business profit, isn't going to be paid any sort of a self-employment tax. So if you earn enough money in your LLC, it's probably going to be worth it to change and elect to be taxed as an S Corp. So that's going to do it for us today, guys. If you found this video useful, be sure to subscribe, leave a comment, give the video a thumbs up for the YouTube algorithm, and as always, I'll see you all again next time. Thanks.